If you're ready for freedom from the grind, then passive income from real estate investing is the best way to get you there. If you don't know where to start or what to do next, then the Rent Roll Radio Show is the best place to get you there. Join us while we discuss the best practices, strategies, and mindset you'll need and give you actionable content to get you from where you are to where you want to be. Hey, Rent Roll Radio listeners, welcome back. As always, I'm your host, Sterling Chapman. Today, I'm really excited to bring back one of my favorite guests from the show, somebody that I've been following since probably day one when interest got piqued in real estate investing years ago. And I love following his economic content. A brief introduction for those of you who don't know him, although most of you who listen to the show probably do. He is the former host of the BiggerPockets Business Podcast. He wrote several books. One of the most notable one is the book on flipping houses from BiggerPockets, the book on estimating rehab costs from BiggerPockets. He also wrote the book on negotiating real estate, which I don't have a copy of because I listened to it on Audible. So I hope you
gotta get you a copy.
I know. I've owned a copy before and I gave it away. So I buy
Even
copies. Better. I buy copies of books a lot and hand them out at our meetups. And then my personal favorite, which I think is very it's a great time to discuss it, is recession-proof real estate investing. So I actually just ordered extra copies of these to give one to everybody in my office because I wanted my team to understand the cycle. And Jay just does such a great job of outlining it. He has a reputation for being the guy who flipped a ton of houses. He flipped 400 something houses coming up. And then I'm always fond of quoting him because he said on our last interview that he regrets every house he ever sold. So I always bring that up in the conversation of why we try and hold as much as we can. And then recently he is partnering with Ashley Wilson and Bar Down Investments. So he has joined the multifamily game and closing some really large projects there and making a lot of splash in the large multifamily space. So super excited to have you here, Jay, and thank you so much for joining us again.
I appreciate it. Thanks for having me back.
So Jay, how did my introduction fare? Did you have anything else you wanted to add to the group from your past or from what you got going on today?
No, I think you're way too generous. I will say I do have a fifth book coming up through BiggerPockets called Real Estate by the Numbers, which is about all the math and finance that goes into underwriting and evaluating deals. So anybody out there that's doing deals would probably really like this book. So stay tuned and be on the lookout for that one.
Now, is that a multifamily focused, or is it a single family, or is it all over?
It's investing in general. So it's basically all of the math and finance and underwriting and numbers-based topics that are going to be applicable to investors, real estate investors. So understanding things like time value of money, understanding metrics like what does IRR mean and what does AAR mean and what's cash on cash return and how do you underwrite a deal and those sorts of things. Basically anything that's numbers or finance related.
Awesome. I'm very much looking forward to that. That is something I think gets lost in the mix a lot. So I know you have a pretty strong numbers background and I have a finance background, but a lot of folks that come out here, they kind of get caught up in the hype and in the social media and when you kind of drill them down, there's a little gap in understanding there. So, awesome that you're educating folks there.
Appreciate it.
Can you, like I said, one of my favorite, and I've learned so much from you over the years, from estimating rehab costs to, a lot of other things. But one of the topics that I love to read every word you post about is the economy. Can you give a rundown of just a current summary of where we're at, where you think we're going, where we came from, and why you think we are where we're at?
Yeah, I mean, let's remember everything I say we should take with a grain of salt, because I think the last time I was on your show was back towards the beginning of COVID, and I think everything everything everybody predicted was wrong. So,
yeah.
so I can admit when I'm wrong, and when it comes to economic topics, it's probably more times than I'm right. So we're all basically just guessing.
That's so funny you say that. I was telling somebody that the other day, and it wasn't just you, it was several other people, but people are always asking me for predictions. And I'm like, well, let me tell you this. Let me start by saying this. I have interviewed some of the smartest guys that I respect the most on these subjects, and they've given their predictions and they've been incredibly wrong. And then I still consider them the smartest and admire them. So it's I always call it like a soft science. Like economics is like a soft science. It's like psychology. Like we generally understand like certain triggers cause certain things, but there's certainly no like definitive crystal balls.
I like to say I don't make predictions. I make guesses. And there's probably a reasonable chance that my guess is a little bit better than some random person on the street. But that's about it. And I mean, there's so many variables that go into economic stuff. I mean, again, we look back at COVID and we saw March of 2020, like the entire economy falling off a cliff. And I don't think there was a single person on the planet back then who would have predicted that within 6 to 12 months, we'd see some of the largest asset bubbles that we've ever seen. I think a lot of people might have predicted it was going to happen 3, 4, 5, 10 years down the road with all the money we were printing, but nobody thought that even before the lockdowns ended, that we'd see the stock market recover and spike. Nobody, I think, expected that we'd see real estate go through the roof again, or we'd see Bitcoin go to whatever it was, 80,000. I mean, that was just a crazy turnaround, and nobody could have predicted that. So again, anything I say here, let's take with a grain of salt, because who knows what can happen. There's so many external forces that we have no control over, no insight into. That we never really know. That said, the nice thing about the economy is we have a really good history of what's previously happened. And in the case of the economy, history does tend to repeat itself to a large degree. So over the last 160 years, we've seen 34 recessions. If you want to count basically what happened last week, the second quarter in a row of negative GDP, if you want to call that officially a recession, and we can discuss if it is or isn't, but that would make 35, I think, in the last 150 years. And so do the math. I mean, divide 160 or 150, 160 years divided by 35 recessions. We see a recession every 5 years or so. And so that surprises a lot of people. A lot of people think, well, I mean, they remember 2008, and then they remember the 12 years between 2008 and 2020, and they think, okay, that's a long time, but that's how long we go between recessions. Maybe we even go longer. The reality is the time between 2008 and 2020, that 12 years between those two recessions was literally the longest this country has ever seen between two recessions. It just so happens that 2008 was such a big catastrophic event, and 2020 was such a big catastrophic event that we tend to think of recessions as these again, catastrophic events. We think 2008, that's what a recession is, or COVID, that's what a recession is. But the reality is most recessions are pretty mild compared to those. Most recessions are, you have a spike in unemployment, and yeah, people are suffering, and it's not necessarily good, but we don't have real estate crashing, and we don't have the stock market crashing, and we don't have all these other asset classes kind of in the toilet. We just have general economic turmoil and a downturn, and sometimes it's worse than others. But in general, recession is just like the next logical phase of the up and down cycle of the economy. And so moving forward, while we very well could have a 2008 type event, or we could have drop off a cliff like we did it during COVID, the more likely scenario is we see a more typical recession, the type of recession that we saw after 2001. So 9/11 put us kind of in a recession, if you couple that with like the tech bubble that we saw in the late 90s. And it wasn't fun. I mean, housing softened and a lot of people lost their jobs, but nobody remembers 2001 like they remember 2008. Likewise, in the early 90s or the late 80s or the early 80s or the mid 70s, I mean, there were lots of recessions over my lifetime. I'm 50 years old. I'm an old guy, so I remember a lot of these, but they weren't 2008 type events. They were just more mild, like not fun economic times that within 12 to 18 months, things started to get better.
Yeah. So what is your expectations around interest rates and how that affects both single family and multifamily?
Yeah, so obviously interest rates are up over the last 6 months. And interest rates, the federal funds rate, the thing that the Federal Reserve sets, that's gone up about 2.5 points, 3 points over the last 6 months. And so that's kind of pushed mortgage interest rates up. And that's obviously slowed down the real estate market. That's actually the whole point of raising interest rates. I mean, we've seen inflation over the last year and a half that's been really bad for this country. People are having trouble paying for housing. People are having trouble paying for food. People are having trouble paying for gas and everything else. And obviously the government doesn't want people to struggle like that. So what they need to do is they need to slow down the economy. They need to get people to stop spending as much, because ultimately that's what's going to lower inflation. So how do they do that? Well, really there's two ways to kind of curb spending and get people to spend less and lower inflation. Number one, they raise interest rates. When interest rates are higher, two things happen. One, people make more money in their savings accounts than they did when interest rates were lower, so they start saving more. And two, with higher interest rates, it costs more to buy a house because your mortgage is higher, costs more to buy a car, costs more to buy anything with a credit card if you don't pay it off. So people spend less money because it costs more to buy stuff. So between saving more and spending less, people spend less money. There's less money out in the economy. And then the second thing that the Fed can do is that they can kind of stop printing money. Like we do a lot of money printing during bad times. They can do the opposite. They can actually pull money out of the economy. And when there's less money in the economy, there's less money for people to spend. And all of these things basically lead to less spending and slowing down the economy, which reverses inflation. And so that's why the Federal Reserve raises interest rates, because they want to slow down inflation. And so this thing that we're seeing now with mortgage rates going up and single family housing dropping a little bit. And I apologize, obviously, as soon as we jump on this podcast, I have my landscapers in the back cutting the lawn.
It never fails. Yeah.
So I apologize for that. But it's kind of by design that we want things to slow down, because that's ultimately what reduces inflation. And so it's not necessarily a bad thing that we're seeing all of this happening. It's a good thing that we're seeing all of this slow down, because over the next several months, the hope is that we see inflation drop. Now, when we see inflation drop, that generally means the economy isn't doing too well. And when the economy is not doing too well, we find ourselves in a recession. And so just like the government and the Federal Reserve doesn't like to see prices spiking and people not being able to afford stuff, they also don't like recessions where people are losing their jobs and don't have enough money to pay for things. So what they'll do is, once inflation is down and we're most likely in a recession, what the Fed's going to do is they're going to do just the opposite. They're going to drop interest rates. And dropping interest rates has historically had the opposite effect. You get less money saving because interest rates are lower, so you get less money in your savings account, and things cost less to buy. Houses are cheaper and cars are cheaper and credit cards are cheaper. So when inflation comes down, the Fed's going to drop interest rates. Everybody's going to have more money to spend. Basically the economy is going to recover. And so typically over the last 60 or 70 years, we've had 10 cycles of interest rates going up, inflation coming down, a recession starting, the Federal Reserve lowering interest rates, and then the economy improving. So 10 times that's happened in the last 70 years. Every time we've started raising interest rates, that's been the cycle. Raise interest rates, inflation lowers, we go into a recession, Fed lowers interest rates, we come out of the recession. That pattern typically takes between 18 and 24 months. So if you want to think that we started raising interest rates, 6 months ago? We're probably within 12 to 18 months of the Federal Reserve getting into the next phase where they start lowering interest rates. So I think we're within a year and a half or 2 years from basically getting back on track and things being where they were, maybe not as crazy hot as they were, maybe not as much inflation as there was, but I think we have about a year and a half to 2 years before the economy's back on track and everybody's like feeling really good again.
Yeah. If I remember correctly, you're a big Ray Dalio fan, right?
Absolutely.
So, and what you just described sounds like the short-term debt cycle, is what he calls it.
Yep.
Something that I've always kind of conceptually had a hard time grappling with is the long-term debt cycle. Can you elaborate a little bit on the long-term debt cycle, how that works, what causes it, and where we are in that process?
See, now you're asking the hard questions. I thought I could just keep this light and simple, but now you're going to make me actually justify some of the things I just said. Okay, so I talked about the fact, and again, this is Ray Dalio has explained this tremendously well. He's got a video out there called like the economic cycle in 30 minutes or something. Yeah. It's a YouTube video. I recommend everybody go watch it. But basically, I just talked about that up and down cycle of the economy where we have recessions every 5-6 years for the last decade, century and a half. And so we typically refer to that 5 or 6 year cycle as the short-term debt cycle. And the reason why we refer to it as the debt cycle is because what we typically see is over 4, 5, 6, and between 2008 and 2020, 12 years, what we see is that there's a lot of credit created. People take out mortgages, people buy cars, people take out credit on their credit cards and other things. And we basically create this inflated amount of debt in the economy. And while the economy is doing well, there's nothing wrong with having a bunch of debt. People are making a lot of money, their wages are going up, their jobs are going well, unemployment is low. But then when we get towards the recession, what happens is people can't pay all that debt. We've opened up all this credit. We've taken out all these loans. But then we get into a recession and there's trillions upon trillions of dollars, 10, 12, $15 trillion in consumer debt. People can't pay that because they're losing their jobs and inflation's really bad. And the bubble bursts. And that's when we start seeing foreclosures and repossessions of cars and people going into bankruptcy because they can't pay their credit cards. And so that's why they call it the debt cycle, because during good times, we open up all this debt and credit, and then everything crashes down during the recession and people lose everything. And then we kind of start over. Well, that's the theory. But the reality is that during each of these cycles, during the crash, we don't lose as much debt and credit that we opened previously. So we had this cycle of up and down, but we're always kind of going up. So each cycle we see a little bit more credit than the last time, a little bit more debt than the last time that didn't get destroyed during the recession. And eventually the short-term cycles result in still enough debt and enough credit being available that there's a really big crash. And Ray Dalio talks about this as the long-term debt cycle, where every 75 to 90 years, we see this really big crash where all those small debt cycles that built up all this credit come crashing down. And we basically end up like back where we were 75 or 90 years ago with respect to credit and debt. And so in Ray Dalio's opinion, the last time that happened was around the Great Depression. So let's call it 1930. And so if you talk about like 75 to 90 years after the Great Depression, we're looking at somewhere around 2008 or 2020, somewhere where we were, where we are. And so there are a lot of people who thought that the 2008 Great Recession was an example of this long-term debt cycle and what Ray Dalio calls a deleveraging. Where basically instead of these small recessions, we have this once in a century big recession. And so there's some disagreement over whether 2008 was that big event or was partial of that big event or was not that big event at all. Then there are people who think that regardless of 2008, where we are now, we're in for that big deleveraging event. Problem is that with anything economics, you really don't know what happened until after it's done and you go back and you do a postmortem and you kind of look. And so we can look at 2008 and we can say, yeah, there was a big deleveraging, but it kind of reversed itself quickly. So yeah.
On the other end of that argument, there is there not some theory around what should have been our deleveraging, but we refused to take our medicine and we printed our way out of it, and
absolutely
all we really did was kick the can down the road.
Yeah, and that's the other thing, and that's why writing the recession-proof real estate investing book was tough, because you want to be able to write a book. I'm an engineer. I was a physics major for a long time, and you want to write a book that follows like laws of physics or engineering, where like
absolute values.
Absolute, yeah. Nobody can change the laws. But the reality is, in economics, there are things we can do to kind of change the laws and change the rules. And one of those is what we've seen a lot since 2008, which has been all of this printing of money. So after 2008, the government printed about $4 trillion. After 2020, the government printed about $8 trillion. In that time, we've kind of only pulled like a half a trillion or $1 trillion out. So we've got like 10, 11, 12 trillion dollars more in the economy than we did in 2008. And so, yeah, you can argue that there was this big deleveraging event, but by printing all of this money, we kind of undid all of that. And so basically we were propping up this economy on all this, I don't want to call it fake money, but all this inflated money, all of this money that's kind of lowered the value of the dollar because we printed so much of it. And that's the thing that's keeping everything going. And the question is, well, there are a couple of questions. One, there's, can we keep printing money? And two, will we keep printing money? Do we have the appetite to keep printing money? And the answer there is, well, I'll answer the second question first. I think the Federal Reserve and the government very much does have the appetite to keep printing money because nobody wants to, I don't think there's any president out there, past, current, or future, that wants to be the guy or gal that's the one that says, okay, I'm going to let everything collapse. So yeah, I think we'll keep printing money.
So, nobody wants to be the president that lost Vietnam. So
exactly. And let me tell you something. This will be the president that could potentially lose the U.S. dollar as the world's reserve currency, which in many ways is going to be much, much worse than Vietnam. It basically takes the U.S. from being the preeminent superpower in the world. I mean, everybody thinks of a superpower as the countries with the strongest militaries. But in reality, the strongest superpowers over the last hundreds of years have been the ones that have controlled the currency. And right now, the U.S. is kind of that superpower that controls the currency. So regardless of military, currency is in many ways even more powerful than weapons. So answering that second question, I think we definitely are going to see continued appetite to keep printing money and to keep like pushing the envelope on money printing. But then the first question was, how long can we do it until something really bad happens? And that's the thing that nobody really agrees on. There's traditional economists. Okay.
What does really bad look like? Like how does that situation climax to?
So what really bad looks like is, so in theory, we can print all the money we want. The problem is when we print money, the way we actually turn it into money is that somebody gives us something in return for it. So if we print trillions of dollars, we basically have to create securities around that trillions of dollars we printed. We have to pay interest on that money that we're printing. We can't just kind of print it and put it out there. Somebody needs to actually do something with it. And so for every dollar we print, somebody's buying a treasury bond or a treasury bill, and we're paying them interest. And them is in often cases other governments, China or Japan, buying up a lot of our currency, and we're paying them interest. And so the more money we print, the more interest we have to pay. And at some point, we don't have enough money to pay our interest, so we have to print money just to pay the interest. And that snowballs. And one day we could get to the point where literally we're printing money to pay interest on the interest on the interest of all the money we've printed in the past. And things just get to the point where we can't print any more money and things collapse.
I lived in Caracas, Venezuela in the late 90s. Yep. And when I moved there in 1998, a bolívar, as their currency, was 500 bolívares was equal to $1. When I left 24 months later, it was 1,900 bolívares was equal to $1. They had printed at such a rate that their currency was a fourth as valuable 24 months later.
Yep. Think of it this way. Imagine like you don't want to pay your credit card bill this month, and the credit card lets you use your credit card to pay the bill. So you have $1,000 bill, and with interest, it's now $1,100, and your credit card company says, okay, we'll let you pay the bill with your credit card. So you pay that $100 interest with your credit card. Now your bill's $1,200. So next month your interest is $120. So you pay that with your credit card, and so now you owe 13 and change, and now it's $150 the next month, and eventually, basically, you're paying more in interest than you are on what you originally borrowed on your credit card, and that's essentially what the U.S. government's doing. And eventually, you just can't borrow enough or print enough to keep paying that debt, and something's got to give.
So I've got one more economic question before I do want to talk a little bit about real estate with you. And so you're typically pretty politically agnostic in public for sure. And
I hate them all.
Yeah, for sure. Same. And so, but my question is, because a lot of the political rhetoric on either side, they like to point fingers at the other guy for this and that. And a lot of times this doesn't have anything to do with that, And so we know the Fed has a lot of control on these major economic triggers, the money printing, the price of fuel, all these different things. How much does the Fed control? How much does the legislative branch control? And how much does the executive branch control? And how do they interact with one another to make, and so does the political party in power, what control do they have on these different metrics?
Okay, you're asking questions above my pay grade. So let me talk in theory first. In theory, the Federal Reserve is an independent, non-political organization. They're tasked with two things. They're tasked with controlling inflation and full employment. So basically, those are their two mandates: keep inflation under control. And when I say under control, not zero. We don't want zero inflation. We actually like a little bit of inflation because our economy growing, inflation is basically the economy growing. Our economy growing is good for a lot of things. So number one is they have this mandate to kind of keep inflation at whatever they think is the right number. And for a long time, they said 2%. Now they're saying a little more than 2%, so averaging 2% long term, whatever that number is. So that's number one. And then number two is keeping full employment. And by full employment, we typically mean like 3.5%, 4% unemployment. That's kind of what we call full employment. So the Fed's job is to do those two things, and they're supposed to be doing that apolitically or nonpartisanly. And they're not supposed to be taking direction from the executive branch or from the legislature. And I think they did a pretty good job of that up until around 2008. Around 2008, it's hard to tell how much the president has control over that. It certainly, Obama didn't seem to publicly pressure the Fed, but that doesn't mean there wasn't stuff going on behind the scenes. It seems unlikely that there wasn't stuff going on behind the scenes. Trump was probably the first president that openly prodded the Fed. I mean, he would tweet out like what he thought the Fed should do. And so I'm certainly not saying he's the first person that kind of got involved in that, but he's certainly the first person that got involved in that publicly. And now we certainly have the White House now under Biden that's kind of trying to muddy the waters with what's going on in the economy by putting out maybe not incorrect press releases on what a recession is. But certainly looking to rock the boat and cause this rift, this partisan rift by doing it. So again, I'm not a fan of any of the administrations going back 20 years. I thought economically, I'll take Clinton any day. I thought economically he did a good job. I thought Reagan did a good job economically. Bush did a good job, the one between Reagan and Clinton. But anything after about 2000, I can find a lot of faults. It's hard to say. I mean, again, in theory, the Fed should be politically agnostic and they should be doing what's best for the country. But we're in very divisive political times, and certainly it seems like the recent administrations have a huge vested interest in ensuring that the economy keeps kind of chugging along. And so you have to assume that there's a good bit of wheeling and dealing behind the scenes. Then from a legislative standpoint, doesn't seem like Congress has a lot of say in monetary policy, but they have a lot of say in fiscal policy. They define like the tax laws, and while those don't necessarily drive the economy quickly the way the Fed does by printing money and raising and lowering interest rates. Anytime you control taxes and who's paying and how much and when, you're controlling the economy. And so certainly the legislature is doing their best to kind of control the economy as well. And so I think the ultimate result is that we have an economy that recently has been relatively strong, but it hasn't been relatively strong for everybody. For some people, those that are well-to-do, it's been extremely strong. The rich have gotten richer. I mean, I read something like during COVID, we were creating a new billionaire every 7 minutes or something. And I don't fact check me on that, or maybe fact check me on that. I don't know if that's true, but I read that. And so certainly those who are well-to-do have benefited a lot by what's happened in the economy over the past 2, 5, 12, 15 years. On the other side of the coin, those who are kind of not as well-to-do have suffered a lot. And certainly we're seeing inflation eat away at real wages. So people are making less money in inflation terms, in real terms. And people are struggled through COVID. And so, I mean, we had a lot of stimulus money, but that money all flowed into assets, which eventually are going to help the rich. And so that's kind of been the interesting thing that we've seen. We talk about, is the economy good or bad? And I think the reason why we have so many arguments about that is because it really depends on your perspective. If you're wealthy, yeah, the economy's been fantastic for the last couple of years. If you're not wealthy, the economy's probably been a whole lot less than fantastic over the last couple of years. And so we're having two different conversations, but people can't see it from the other side.
Yeah, for sure. Well, let's dive into real estate for a minute. Just real quick, you still do some single family stuff, right? I want to say not too long ago, I saw you flipping a house on Facebook or something.
Yeah, so I think that was the last house. I've been working on that one since like pre-COVID or beginning of COVID. That was the last house I kind of flipped on my own. And it took me 2+ years and it frustrated the hell out of me. And so I'm still doing some single family with a couple partners where I'm more completely passive. I put in some money and I do some consulting. But day to day, I'm doing essentially no single family anymore other than some rentals, not doing any flipping right now.
Okay, cool. And so how has your strategy been impacted by the changing economic environment on the multifamily side? I get a lot of pushback about, what if interest rates shoot up? Are you buying rate caps? Are you underwriting differently? How are you protecting your investors not knowing what's coming?
Yeah, so I literally got into multifamily back in 2018-ish because I wrote that book, Recession-Proof Real Estate Investing. And while I was writing the book, I was kind of using that time to kind of think about what asset classes I wanted to be in, because I believe that we were heading towards a recession in the 2019 timeframe. Obviously, we got there in 2020 for reasons I completely didn't expect. Yeah, for about 2 weeks, exactly. So it didn't play out the way I expected it to. But back in 2018, when I was writing that book, I was thinking about a recession coming and where I wanted to be when that recession came. And ultimately, I determined that multifamily was probably one of the most resilient asset classes, at least within real estate, maybe even overall, to be in during a recessionary period. Yes, we certainly are going to see higher interest rates, and that's not going to be good for multifamily. We may see higher unemployment, which isn't necessarily good for multifamily. But all things being equal, those things are going to hurt other asset classes more than they're likely to hurt multifamily.
I've heard contrarian arguments on those two subjects.
Yeah.
With raising interest rates creates a higher barrier of entry to home ownership, right? Which means they got to rent longer. And then unemployment or, bump down employment, you lose your big fancy house and you got to move into an apartment.
Yeah. And so a lot of it has to do with like what class of multifamily we're talking about. And so there's niches within niches. So certainly I don't want to be in A-class multifamily. Because A-class tends to be high-level white-collar workers who are paying premiums for the highest level amenities and the newest apartments. And any time that you have a recessionary period, while the white-collar workers might be the most insulated, they're still going to take a hit. And so certainly A-class has some risks associated with it. These days, C-class property has some risks associated with it. Again, we were talking about, I didn't use the term K-shaped economy, but we have this idea of the rich are kind of getting richer and the poor are getting poorer. And so certainly those on the lower end of the socioeconomic spectrum that live in the C class and maybe even the D class housing, they could get hit extra hard during this upcoming recession. And so that could be a bad place to be for multifamily. But yeah, like you pointed out, there are certain classes of multifamily, and I think B class is kind of the perfect example of where, again, both interest rate hikes and unemployment is actually a good thing, like you said. So again, it really goes back to really divvying up what we're talking about in multifamily. So I really like B-class multifamily. That's kind of where I'm focused these days. Yes, so as somebody who buys multifamily, interest rates do tend to hurt us in the sense that it makes it harder for us to provide attractive returns to investors. Over the last several years, we've seen interest rates really, really low, which means we're not spending as much money on debt service, on our mortgage. And so there's a lot of money left over every month to be paying our investors' cash flow. Now that we're paying several points higher in mortgage interest every month, there's not as much money left over, and so our investors are seeing much less cash flow. That said, they're not going to get high cash flow in most asset classes these days. And so the question really becomes not so much what does the cash flow look like this month or next month or the following month, but what is the prospects for the asset itself over the next 2 years or 5 years or 10 years. And I think, like I said, I expect interest rates to be down again in the next year and a half, 2 years. And I think values for multifamily will shoot back up. And so while, I think our investors are struggling through lower cash flow for the next year or two, and we're struggling through lower cash flow for the next year or two, I think ultimately multifamily is in a really good spot to continue to thrive, to continue to see high occupancy, to continue to see rent growth. I mean, anytime you have inflation, you're going to have rent growth. And so I think over 2, 3, 5 years, multifamily is going to do really well.
Yeah. Can you give us a breakdown of kind of like your deal structure, your hold time, your business plan, your splits, kind of how you put them together?
Yeah. So we do syndication, which basically is just a way of financially structuring your investment. And syndication is basically just this idea that you have somebody that comes in that operates the deal, and then they bring in a whole bunch of completely passive partners to put a bunch of money into the deal. The passive partners, they get returns, but they don't have any day-to-day say. So it's like putting your money into the stock market. You get returns back, but you don't actually do anything. And so we structure our deals. We're the operators. We have passive investors. We actually are also passive investors in our own deals. And so our deals, we typically look for we look in areas that are seeing population growth, that are seeing employment growth, that are seeing employment diversity. Because again, when we're talking about multifamily, we're talking 2, 3, 5, 10-year deals. And the biggest driver of income and success over 3, 5, or 10 years is going to be population growth and employment growth. People move to places where there are jobs, and where people are moving, that's where multifamily is going to do well. So we look for those types of areas. Typical deal is a B-class deal. We're typically looking at 150 units and above, built between 1980 and 2010. Our hold time is generally 3 to 5 years. And these days, returns for multifamily investors, passive investors into multifamily deals, we're seeing around 6% per year cash flow. And we're seeing around 14, 15, 16% maybe total returns on the back end.
In terms of IRR?
IRR 14, 15, 16%, average annual return 16 to 20%. So depending on how you do the math. And again, I have a book coming out that talks all about that math.
Yeah. I'm going to be giving away a lot of copies of that book because I'm constantly breaking down the difference. Well, you said yours deal says it's a 15% IRR, but that guy said he'd give me 17% a year. I'm like, well, that's an average annual rate. This is an internal rate. And here's the advertise to your investors for.
So it's funny. I've seen things change a lot over the last couple months and last year. I think as returns have gone down because interest rates have gone up, we've started to see investors who we have these two common rates of return. We have this IRR, which is a compounded rate of return. That assumes that every time we give you $1 back, like in cash flow or whatever it is, you reinvest that money. So it grows faster. And then there's the average annual return, which assumes that at the end of the deal, you have this big pot of cash back, no matter when you actually received it, and you divide that total return by the number of years, and you have your average return. And so that's why we see these two different numbers, and there's some nuances to both. But typically speaking, IRR tends to be lower than average annual return. And so previously, we could use IRR kind of as that metric, so 14, 15, 16%. But now that IRRs are dropping down, people are starting to quote that higher
12,
number.
Yeah.
Right. Now they're quoting 14, 15, 16%, but that's the AAR. And so I think a lot of investors who aren't savvy and don't know the numbers, they see, oh, this deal is just as good this year as it was last year. And what they don't realize was that 15% number that they're seeing this year is a different number than the 15% number they were seeing last year. So the math is different, but they don't realize that. And so I'm starting definitely to see that. And then there are games that we as operators can play. And so one of the big things I've seen is for IRR, again, this is a compounded return. So it assumes that you're reinvesting the money that you get back. And because you're reinvesting the money that you get back, or it assumes you're reinvesting the money you get back, the sooner you get money, the faster you can reinvest it and the faster it grows. This idea of time value of money.
Sure.
So if I offer you
we do an early refinance and model that out about reinvesting that capital, and you got hockey stick growth at that.
You got hockey stick IRR. Likewise, something as stupid, or not stupid, but as simple as if you and I have the exact same deal and you're paying quarterly returns and I'm paying the exact amount of returns, but I'm doing it on a monthly basis. So instead of giving back $900, or let's say $900 in a quarter, you do it at the end of the quarter. I do $300 a month. So we're giving back the exact same thing, but I'm doing it monthly because you're getting my money back a little bit faster than they're getting your money back. It actually bumps the IRR up. So we could have the exact same deal, but if I pay monthly and you pay quarterly, even though the investor isn't going to necessarily do anything different with the money they get back, my deal is going to look better than yours, even though it's the exact same deal. So there are lots of tricks that can be played as well.
Yeah. So what I'll do with a less sophisticated investor is I'll start with the equity multiple and work my way backwards. Right. I'm like, well, here's the deal. You're going to double your money. Now you can look at it. It could either be a 20%, if you double your money over 5 years, it could either be a 20% average annual rate of return, or it could be a 15% IRR,
Yep.
So don't get confused about it. What's going to really happen here is you're going to double your money over 5 years. Now, the early refi. So
now keep in mind, I see some operators now that are saying we're doing a 2x multiple, but they don't say 5 years. They don't give a time frame.
Yeah.
And so they might be thinking 7 years. And so getting your money back, doubling your money in 7 years obviously isn't as good as 5 years.
It isn't. So a lot of our projects we'll model it for 7 years, but we'll model in a refi at like 18 to 36 months.
Yep.
And we've got a project right now where we're returning 100% of investor capital from 18 months ago. And every single one of it is pouring that money back into a project that we're closing on next month. And so what's going on there is that same $100,000 is now working for you in this deal and this deal. And that's as long as we have another deal lined up for you to reinvest that capital when we give you an early refinance, I mean, you're really doing good stuff there when you got your money working for you in multiple places at the same time.
100%. 100%. And that's that. I like to tell everybody that's investing in these deals, it's worth taking some time to really understand the numbers behind the deals and where those numbers are coming from, and what's actually happening with your money. Because again, I think you and I certainly do the right thing by our investors, and they're always like focused on being upfront, but there are a lot of new and not even new. There are plenty of syndicators out there that can kind of obfuscate the returns by using weird metrics or not disclosing things. And so it's if you don't understand the math yourself, it's really easy to be deceived in this business.
For sure. Well, I could talk all day, but I know that you're going to want to cut me off at the hour. So I want to move over to our radio round in the sake of time. And I imagine you probably don't remember your answers from 2 years ago. So
I don't.
And they've probably changed. Whenever somebody asks me what my favorite book is, it's usually the book I'm reading. But it's just 3 quick questions. So the first one is, what's your favorite book?
I can probably guess the book I said 2 years ago, because I've been saying the same book for like the last 10 years. There's a book called The Goal, and nobody's ever heard of it, but it's an amazing book. So let's pretend that was the one that I gave. So let me give you another one this year. Let me look at my bookshelf right now and see what I'm reading right now. So a book that I've just finished that I really loved is a book called Who Not How. Yeah. And it's basically all about stop focusing on how you can do things better in your business and more efficiently in your business, and how instead you can bring in people in your business to do things for you so you can scale that way. And what I found going from single family to multifamily over the last few years is it really is about being able to scale your time in order to scale your business. Multifamily is a team sport, and if you try and do everything yourself, you're not going to accomplish anything. And bringing in the right people in the right positions is definitely the way to scale the business and ensure that everything's being done optimally.
Yeah, I love that book. That's Cal Newport, right?
Yep.
Yeah.
Oh no, not Cal Newport. No. It is.
Who Not How?
Can't see it from here.
No, that was Deep Work. That was Cal Newport. What was the other one?
It is, looking it up on Amazon, Dan Sullivan and Benjamin Hardy.
That's right. No, that's so true. In the first, year and a half, I tried to make the transition from single family to large multifamily. That was, I think, I started trying to make that transition in 2019. We didn't get our first project, and, we didn't close on our first large project until the beginning of 2021. And it's because the first year and a half, I was trying to do it all myself. And now that I look at my team and my partners and who does what, I don't really have any desire to do what they do.
Yep.
We've kind of, there's 4 of us that work together. We've really niched down in what we enjoy doing. I've got partners that are the best underwriters I've ever met, worked for Starmont for years and other private equity firms. And they're just fantastic underwriters, but they wouldn't dare be on this show right now. Right. And I've got other partners that are just way more organized than me with their follow-up with the lenders, with the property managers, with the construction crews from an operations standpoint. I've got other ones that are just, as I'm building investor relations, they're building broker relations. So once we niche down and triple down on what our core competencies was versus trying to do everything ourselves, it really started to take off. The next question is, what's your favorite quote?
Ooh, that's a tough one. One that I've been thinking about a lot recently is it's something that goes along the lines of how you do something is how you do everything. And it's really it's a testament to consistency. And I do this when we hire. A lot of times I will ask questions around how potential candidates do relatively mundane things. because how you do the simple and the mundane is pretty much going to reflect how you focus on the most important and big things that you do in your life. And so I'm certainly an 80-20 rule kind of guy. So like, I'm not like trying to be perfectionist on anything. But if you kind of aren't paying attention to the details on the little stuff, you're probably not paying attention to the details on the big stuff either.
Absolutely. Awesome. And then what's your favorite thing to do outside of work?
Family. And I'm guessing that's the same answer I gave last time, but I'll stick with it. If I need to give another one, I can probably find another one, but certainly I have two boys, 11 and 12. We just got a new puppy and I'm starting to recognize.
I'm about a decade behind you. I've got a 3 and a 2.
Let me tell you something. Everybody says it. I'm not telling you anything you haven't heard a million times. It goes fast. And you think you have 18 years. And so you're like, okay, you're probably thinking, okay, I've got 14 or 15 more years with them. Yeah. Once they get to around 10, 11, 12, what I'm finding is that they're not too interested in hanging out with mom and dad too much anymore. So we need to take every moment we can get, because I have a feeling in a year or two, they're going to be completely done with us.
Oh man. I got on this kind of, I was interviewing Brandon Turner a few weeks ago. We got on this topic and both of us at the end were like, all right, I got to go. We got to go hang out with our kids. Well, Jay, how can our listeners get in touch with you, learn more about you, invest with you, buy your new book, follow you? What's the best way you're linking up with people these days?
I appreciate that. So easiest is probably go to www.connectwithjscott, just the letter J, scott.com, connectwithjscott.com. And that'll link you out to anything. That's my Linktree account. And then I have links on there to everything I do.
Awesome. Well, Jay, thank you so much for joining us. I learned a ton. I really loved it. I know our listeners are going to learn a ton. And as always, we appreciate you and we'll definitely keep following you.
I really appreciate it. Thanks for having me back. Looking forward to next time.
This episode was brought to you by Crestworth Capital. If you're a busy professional and ready to make passive income from real estate investing, then go to crestworthcapital.com, where you'll be able to download a free copy of our ebook to help you get started today. Until next week, happy investing.